Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, on today's show, we have Victor Dergunov back with us. Victor, thanks for joining us.
It's a pleasure to be here, Brian. Thanks for having me on your show.
You bet. Well, last time we had a really enjoyable conversation about Tesla, at least one that I enjoyed and learned a lot from. And today, I'd like to focus a little bit on Netflix. Around a month or so ago, you wrote an article in Seeking Alpha focusing on Netflix entitled Netflix Substantial Profitability Potential Likely to Drive Stock Even Higher Going Forward. And then obviously, I guess a couple of days ago now, this is mid-July 2018, Netflix reported earnings and there were disappointments in terms of new subscriber growth, and there's been some sell-off and some other things with the stock. So that kind of factors in a little bit. Do you mind sharing a little bit of kind of your thesis behind that article and any relevant updates?
Yeah, sure. So, my prior article, the one that you're referencing, the Netflix Substantial Profitability Potential Likely to Drive Stock Even Higher Going Forward. So, I wrote that about a month ago, and basically the thesis behind this article is that Netflix is a company that you can't really value it on a PE basis, because obviously it trades at an astronomical PE, like 80 times forward earnings. It's even tough to value it on a price to sales ratio, because it trades at about 8 times forward revenues. So basically, but the stock still has lots of demand, and the reason for this is because Netflix is a company that is still in hyper growth mode, even though it's been around for quite a few years. Obviously it's an amazing business. The company is still in hyper growth mode, growing revenues at around 40% year over year. So basically the thesis behind this article was that currently Netflix's share price, and actually I wrote the article right around the time when Goldman Sachs came out with their $490 price target on Netflix. So the reason that the stock gets so much demand and gets all these extremely high price targets, even from the smartest guys on Wall Street, as I refer to Goldman Sachs, is because the company really does have enormous profitability potential going forward. So the worldwide market is not it's really not that saturated with Netflix, because there are well over 3 billion people with internet access in the world, and there are only about 130 million Netflix subscribers. So basically, the idea is that Netflix can continue to grow its user base, especially its international user base, at a substantial pace for quite a few years into the future, 5, 10, possibly more.
And you said current subscriber base is around what again?
It was reported at 130 million
Okay.
just this past Monday, when the company came out with earnings.
Right. Okay.
Yep. So the subscriber base, it's huge, right? 130 million, but that doesn't mean that it can't get much greater, because actually more than half of the subscribers are now international. For instance, this past earnings, 130 million, 57.4 million are in the U.S., but 72.8 million are now international subscribers. So once again, the idea is that the company can continue to grow international subscribers, and by my models, the company can reach around 345 million subscribers in the year 2023, and by this time, the company can also increase its monthly fee by a little bit, say to an average price around $15. And this will enable the company to generate enormous revenues, over $60 billion, say in 2023. And just to put that into context, 2019 revenue is projected to be around $20 billion. This year's revenue is around $15 billion. So I mean, you could you could actually see that by that time.
You said 2019 is projected to be 22 billion.
Around 20 billion.
Okay.
Those are consensus estimates. It could be a bit higher than that, but likely around 20 billion.
In 2018, about 15.
Yeah, about 15, slightly higher than 15, but between 15 and 16 for this year, something like that.
Wow. Okay. Yeah. So again, another growth story stock, and so you have another dynamic, like the typical knock on Amazon, for example, is high PE. The PE, the normal valuations of like PE and price of sales just don't work, and you get the argument, well, all future benefits are already priced in, and which those arguments make sense on paper, but what I feel like one of the challenges that happens is the sentiment dynamic. And this is one of the things that, I appreciate from like investors like Avi Gilbert. Whether or not anyone goes along with Elliott wave theory or not isn't the issue, but the idea behind it is that ultimate sentiment is what drives stocks. And even the saying that, in the short term, it's a voting machine, long term, it's a weighing machine, that's a sentiment comment, because basically over time, the assumption is sentiment will eventually match up with quote unquote reality. But the thing is, it's still sentiment based. And so today, I guess the thing with a company like Netflix is, well, okay, maybe future potential is technically priced in from a fundamental standpoint. But the question is, will investors continue to be enthusiastic and excited about the stock? Does that sound fair?
Yeah, sure. Absolutely. Sentiment definitely drives the price action in stocks and just about anything for that matter. And there are just not that many companies out there like Netflix. Netflix, it's a one of a kind company, and you referenced Amazon, and yes, Netflix is it's an Amazon type company. It's a Facebook type company. It's a Google type company. It's a company that just absolutely dominates its market, its area, the streaming business. If you look at some statistics, for instance, I just want to provide this one statistic that I find very interesting. It's the average, it's the time spent streaming by video platform in the United States. So if we look at this metric, Netflix captures nearly 50% of this. There was a poll taken. It's in my article, actually. There was a Nielsen poll taken in 2017, of which showed that 46% of time spent streaming in the U.S. is done via the Netflix platform. So now, to put that into context, if we take a platform like Google, or I'm sorry, YouTube, which has which has just an enormous amount of users, it only accounts for 15% of times, of time spent streaming. So that's Netflix, surprising. So Netflix essentially triples that. And if you take a company like Amazon, it only has 4% of the market share. So once again, Netflix just completely dominates. Hulu, 8% of the market share. Everyone else about 27%. So Netflix here is a dominant force, and there are just not that many companies like Netflix that provide the growth and the revenue and eventually the profit potential. So that's why the stock has such high sentiment, has such high demand, and gets bid up consistently.
Well, and that makes sense. And one thing that really stood out to me too recently was when Netflix received more, was it Emmy nominations than HBO? And yes. Because the thing for me for years has been with Netflix has been like, it doesn't matter, like the streaming dynamic isn't necessarily unique to them, because any content provider can, like ESPN can create their own, they're doing that, create their own app and then charge people access to it and stream content that way. And so ultimately, whoever owns the content has the bigger advantage in most cases, which obviously Netflix realized, and that's why they've poured so heavily into content creation. And it's amazing how well they've done. And you kind of wonder what some of the other cable companies or big content creation companies are thinking. Like how did Netflix jump ahead so far so fast? These companies have been around for so long. It's pretty amazing.
Yeah, Netflix is incredible in this sphere. The content creation, if you consider, how much time the company has been around for, and how much time it's been creating content, which in all reality is not that long, especially when you compare to companies like Disney and like Time Warner, HBO, and like the other big content creators like Fox, etc. It really hasn't been around for that long, but they've just been able to create such amazing content. You take shows like Stranger Things. You take shows like I mean, there are just so many shows that are amazing on Netflix. And you mentioned the Emmy nominations. So yeah, Black Mirror, Mindhunter, Stranger Things. I mean, all these shows are remarkable. And for the first time ever, yes, Netflix actually surpassed HBO this year in Emmy nominations. They've been coming closer and closer. For instance, in 2017, 91 Emmy nominations versus HBO's 110. This was a big jump over 2016. And this year they finally surpassed HBO. So, I mean, I've called Netflix like the content king, and I will go out on a limb right now, and I will say that Netflix is, at least in my opinion, the new content king, undoubtedly. So, yeah, definitely amazing content, and it goes a long way, and the company gets remarkable bang for their buck. And another element, this is the thing that makes Netflix so successful, and that sets them apart from all other content creators, is that Netflix smartly began creating international content for various countries, various markets around the world. I mean, they have great South Korean content, original programming, great Japanese original programming, Italian, French. I mean, you name it, Netflix has several series, shot on location using local actors and actresses, in the country's language. This is amazing because it creates demand from all over the world, and this is why Netflix has been able to just crush the international numbers. Just keeps growing subscribers internationally all over the world, and that's really what separates the company from the rest.
There seems to be no doubt that they obviously have a content creation strategy very unique than, let's say, a traditional content publisher, whether that be Disney or CBS or NBC or ABC and those traditional companies. And I kind of, as I hear this and think about it, it's almost like so many other industries where there's disruption. There's like an old traditional model that's probably very I'll say overly restrictive in terms of how content's created. Maybe I'm not sure. I don't know what all the steps are for creating content or new shows on, say, for example, NBC or CBS or ABC. But obviously, whatever that process is not creating the same content that Netflix is. And my assumption is that Netflix is probably allowing content creators much more freedom and opportunity to just create great content and use their gifts, as opposed to, I'm assuming these larger content houses probably have lots more restrictions and cookie cutter approaches that restrict that empowerment and freedom, is my assumption. And that just allows Netflix just to continue to find great opportunities at lower prices and just keep creating great stuff.
Yeah, absolutely. Netflix definitely found a very interesting approach to creating content, and I've been able to identify several elements to their strategy that really separates them from the sort of traditional content creators. So I noticed that Netflix puts a lot more emphasis on series over movies. I mean, they just continuously create great series after great series after great series. And this keeps people tuned in. This keeps people, binge watching. as opposed to traditional content creators who, they release like one episode a week or whatever,
Right.
or one episode like every few days. Netflix just puts that whole series out there, and then bam, people can just tune in, can binge watch. I mean, they spend a lot of time on the platform, and then something new comes out, and they tune into that,
Right.
and et cetera, et cetera. The cycle never stops. So yeah, in series they're often cheaper to produce than huge Hollywood blockbuster movies, and once again, it just seems like Netflix just gets more bang for their dollar doing this. And then another element of the strategy is obviously the emphasis on the international content, which is extremely important if you're going to attract people from outside of the U.S. and outside of the English speaking countries, so to say.
Well, let's focus. I want to come back a little bit to what I think is probably one of the core issues that a lot of investors may have with Netflix, because I think most investors would say, hey, it appears to be a great company, probably keep growing, and probably don't have, I wouldn't think many people have a lot of arguments in terms of great company, great growth potential, but obviously the price dynamic is people will always say, as you already did, yeah, but the PE or the price of sales. And I'm trying to think through like how, what different ways we can address that or break through that, even more than we already have, because the existing argument of, yes, those metrics don't work because of the great growth potential, and so you have to think about that. But then someone will come back and say, yeah, but all that growth is already priced in. I'm curious, how do you sift through that tension in terms of creating future valuations for the company? And this may be an ignorant question because I haven't done the math, but I'm wondering, like, what at the current stock price, for example, what annual revenues are they pricing in? And and some of those, I'm curious how you address some of that.
Sure, no problem. So first, let's talk a little bit about the earnings report that just came out, because basically when I look at the stock and what makes the stock go up, it's not the earnings per share, because that means very little for Netflix, because like I said before, the company is still in hyper growth mode, so the EPS it's just pretty much meaningless right now. The revenue figures, sure, they're important, but really what's most important is the subscriber growth. So let's get back to this earnings report. So I'm sure you've noticed, and people who are listening, I'm sure noticed that the company stock pretty much cratered by about 20% on Tuesday after the sort of, I guess, the disappointing report that came out on Monday. So let's sift through this a little bit and just identify why the stock tanked. So we see that Netflix reported $3.991 billion for the quarter. Estimates were calling for $3.94 billion, so missed by about $30 million. However, if we go back to the end of Q1, we saw that Netflix guided for $3.9 billion. So they actually beat their guidance. I'm not exactly sure why analysts were so optimistic predicting $3.94 billion, but all right, they missed their EPS.
So analysts predicted 3.94 million new subscribers, but they had 3.9 million.
No. This is revenue.
Oh, okay, that makes more sense. Okay.
Yeah. So EPS they beat by a little bit, but once again, that's people don't really look at that, and I understand why. They beat by 8%. 79 was the consensus estimate. They reported 85 cents. But let's get to the subscriber figure. So Netflix missed by quite a wide margin. They were expected to add 1.23 million domestic subscribers. They added only 674,000 domestic subscribers, so quite a big miss, almost by 50% there. So that was a main reason. International subscribers, they were estimated to grow the international subscribers by 5.11 million. They only grew by 4.47 million, so quite a large disconnect there as well. Overall, they missed by about 20% on subscribers. And this is why the initial reaction was so negative in the stock. Many people said, "Oh my God, wow, Netflix finally missed the quarter. This is horrible. This is the beginning of the end." Maybe some were saying they sold off the stock, and bam, the shares cratered by 20%. But if you notice, the stock got bid up quite quickly, and by the end of the trading day, the stock had regained about 15% of the losses and closed down by only about 5% on the day. Why did that happen? Because when you take a closer look at the numbers, it's actually not so bad, especially if you consider that last quarter was such a blowout quarter. So last quarter, Netflix basically beat by about 10% on subscribers. It was a huge blockbuster quarter, just amazing. And if you take both quarters and add them together, actually Netflix actually beat the estimates for the first half of the year. So when you look at it from this perspective, you can kind of say that possibly, probably even due to the significant additions in Q1, it was kind of the company can't continuously just smash estimate after estimate. That's not realistic. That's just not how things go. So I mean, one quarter they're gonna do extremely well. The next quarter they might miss by a little bit. But if you combine the quarters together, you see that actually Netflix still grew their subscriber base by about 10 million in the first half of this year, which is which is pretty remarkable. So that's the way I choose to look at the earnings. And I'm sure lots of other people, once they digested the initial numbers, they said, well, perhaps this isn't so bad. One quarter does not make a trend.
Right.
So, they went out and they bought the dip. They bought it aggressively, and we see that so far that's working out for them. As far as future revenues go and how we can maybe value this stock, I mean, usually, typical stocks are valued on like either this year's or like next year's earnings. Lots of people use like a forward price to earnings ratio, which is like which would be 2019's earnings right now. With Netflix, because of the enormous growth and the huge profitability potential that has not yet been realized, you have to go out a little bit further than that. So maybe 2-3 years into the future, and then you could kind of start to really get an understanding for what this stock will be worth in the future. So basically, like I was saying before, if you go out to maybe about 2022, 2023, I mean, Netflix could be delivering around 50 to 60 billion in revenues by then. So I mean that is a huge number. To put that in context, like I said, about 15 billion this year. But if we go back a few years, we see that in 2013, Netflix's revenues were only about like let me see, I have the figure right here. In 2013, Netflix revenues were 4.3 billion. In 2014, 5.5 billion. So I mean, when we start talking about 20 billion in 2019, something like possibly like 50 billion in 2022, these are significant, just enormous numbers. Now, if we look at profit, we see that as Netflix is growing, its profitability is also increasing substantially. For instance, in 2016, the company's profit margin was something like 2.8%. This was in 2015. I'm sorry, 2016. It was something like about 5%. 2017, it was a little bit higher. This year, 2018, 2019, we're going to get to about 10% in net profit margin. So if we go out to, we can definitely see that there's a trend here that
right.
as Netflix continues to grow subscribers, continues to attract more and more revenues. I mean, just the revenues are starting to greatly eclipse the operating costs and the content creation costs and all that. So we can basically assume that by 2022, 2023, Netflix's profit margin is going to be between 15 and 20%. And if we use like a rough estimate, about about 20% of 50 billion, we arrive at quite a big figure. So we arrive at about 10 billion in net income in like 2022, but by around that time. And 10 billion in net income would suggest that Netflix would earn about $23 a share, which would then kind of give it a PE of about 15 at the current price. I know we're looking out quite far here, 2022, but then again, 2022 is only like 4 years away. But like I said, in order to put kind of a valuation on Netflix, you have to go out, a few years into the future. This is not a stock you can value effectively, looking at 2018, 2019 numbers.
Well, and I guess the assumption too there is people will say, well, yeah, you just proved my point. The future's already priced in. But the thing is, in 2023 or 2022, you don't expect growth of Netflix to stop.
Exactly.
So at that point, maybe in 2023, maybe 2018 is pricing in 2023 revenues, but the expectation would be that in 2023, it'll be pricing in, let's say, 2028 revenues. And so that's where, again, that sentiment dynamic and expectation of investors is so important, because like you said, as long as that strong growth continues, then that shows evidence. Well, you can keep playing that game, for lack of a better way of saying, of kind of rolling more future earnings back into today.
Sure. And that makes perfect sense. Netflix's growth, it's not going to stop in 2022, not going to stop in 2023. Sure, it's going to slow down. The company is not going to continue to grow revenues at 40 or 30%, forever. So possibly in 5 years, 5 to 10 years, sure, revenue growth will slow down to maybe about 20%. After 10 years, maybe to around 15%. But still, that's a relatively high growth company, especially in this environment. And then you have to consider that we're probably in the later stages of this current bull market. So people are going to continue to chase that alpha until the bull market ends. I'm not going to go out on a limb and say exactly when it's going to end. I don't know. It could be next year. It could be 5 years from now. It could be longer. Who knows? I mean, we've been in this extremely easy monetary environment for so long. This bull market can go on a lot longer than prior bull markets have. Who's to say that it won't?
Maybe this podcast will be the trigger for the next bear market. Maybe like just us discussing the negative views. That's probably what it's going to be. So everyone listening, this is your cue, right?
That's possible too.
That could become an episode of Stranger Things, maybe, because definitely not true. So tell me this: one more question I have, kind of blending those conversations together. I was reading the other day about how Netflix, the FANG stocks, Netflix, Facebook, Amazon, Microsoft, Google, Apple, those companies have been just huge contributors, like vastly outsized contributors to growth in markets over the last year and beyond. How much of that concerns you? And specifically regarding Netflix, it's taken off, it has had huge growth. One of the critiques with why there's such a sell-off in the last week was, well, the company is priced to perfection already. How much does that disconnect with broader markets concern you regarding the stock price of Netflix? Or do you ignore it?
Mm-hmm. All right. Well, first, I want to say that not all FANG stocks are created equal. Basically, I put Netflix and Amazon kind of in a category of their own, just because they are such high growth, high multiple stocks that they're a little bit different. You have to kind of classify them separately, because yes, they are, I guess you can say, very expensive, frothy, overvalued, call them whatever you want. They are, yes, maybe they are priced for perfection. They are basically expensive stocks, and if something were to happen, some kind of something negative in the economy, they could lose great portions of their value, no doubt. But if you look at other stocks, like I guess FANG stocks and Microsoft, you referenced Apple. If you look at Facebook, if you look at Google, if you look at Apple, Microsoft, and many other stocks that have contributed so much to this latest leg in the bull market, I guess you could call it. These companies really are not expensive. I mean, Facebook is trading at, I mean, by my metrics, is trading at under 20 price to earnings multiple, forward price to earnings multiple. So basically, Facebook is currently trading lower than 20 times 2019 earnings. That's cheap in my view. If you look at Google, it's trading at something like 20 times 2019 earnings. Apple, something like 12 or 13 times 2019 earnings. So I mean, these companies are far from expensive, but yes, they have they have grown a lot. They have appreciated a lot. I can't say that that I guess concerns me too much, but this, like I said before, this bull market is going to end when it's going to end.
Sure.
But before it does end, these stocks, they're going to continue to go up because they've been leading the way, and they're going to continue to lead the way unless something systemic happens with the company, or unless something starts to give with the economy, like it's going to start to contract. But it doesn't appear that that's going to happen, at least within the next several quarters. So I mean, they're going to keep going up until this bull market is no more.
Awesome. Well, Victor, thanks so much for spending time with us today, discussing Netflix and other things. Enjoyable and helpful as always.
Thank you, Brian. It's been my pleasure, and I hope that we speak soon.
Yeah, look forward to it. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.